Welcome to the Capital Discussions Roundtable. I'm Tom Nunemaker with Jim Riggio and Paul Demers today. Before we get started, we have a disclaimer that Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer-simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. And this disclaimer is at the bottom of all of our web pages if you care to read it in its entirety. So with that, welcome, Paul, and good to see you on the roundtable. And Jim, do you want me to give you the ball or Paul first?
Oh, I think Jim should take the ball first.
Is it the one, is this the right one, Jim, or is it the other Jim Riggio? Hello, Jim. Are you muted? We don't hear you, Jim. I'll have to pick up my violin pretty soon. Jim, where are you? Oh, John, no, it's more classical music, not the good stuff. So it's more Bach, Beethoven, Chrysler, things like that. I'm no Perlman, but it sounds like Jim reconnected. Is that true, Jim? Oh, looks like I need to promote another Jim Riggio. Let's see. There we go.
Triplets.
Yeah. Hello.
Hey guys, sorry about that. I don't know what ended up happening. It's I seem to just drop my connection.
Okay. All right. So, Jim, let's see.
Yes, if you pass me the ball, that would be great.
Is that the right one?
Yep, that's it.
Okay, great. You got it.
Sorry about the confusion, guys. And let me come over here and. Are we good? Can you see my screen?
Yes. Capital Discussions Managing by the Greeks.
Perfect. Okay. What I wanted to end up doing today is, there have been a lot of different discussions about managing by the Greeks and different strategies. So what we wanted to end up talking to you a little bit about the Greeks. And, I don't know about you guys, but when I was learning Greeks, it's, I thought that Greeks ended up lying. Tom put together this three. Well, while all men may have been created equally, Greeks have not been. There's a real big difference, okay, how Greeks will actually end up being different at different points in the trade. So when you end up thinking about how to end up managing by the Greeks, I know there's been a lot of discussion of Brian Johnson's work. And I think it's absolutely great, in what he's done. And there was a really, really strong trader group, that Tom hosted on Tuesday. Dan Harvey came in. He had been using this strategy from Brian Johnson. And it talks a lot about delta versus theta risk. It talked a lot about Vega. I'm sorry, Brian Johnson. Did I say that incorrectly? Vega versus your theta. And, we always talked about ratios, and I think that his work, it's kind of taking a look to the next level. Tom, for the folks, and also I know that you had read the book, and also Paul, you had. What were some of the things that you found most useful, in Brian Johnson's work, and also, if you can, Tom, I know that you got a lot of really positive feedback about the trading group that you and Dan Harvey did on Tuesday.
Yeah, in fact, I just promoted Brian. He's here, so Welcome, Brian, to the roundtable. It's great to have you here. But the book was great. I know it started out with delta theta, Vega theta ratios that we'd used a long time in shared mentoring, but it definitely took it to the next level. And it was nice to have a measure of risk that looks at price and also volatility risk that you can apply across different trades and different time frames.
Yeah. Paul, I know that you had read the book and you had built basically the formulas into your own spreadsheet. Any comments about how you end up using them and how it's changed your thought about looking about ratios of your movement versus your time risk?
Well, it's been interesting process. I read the book. It's a great read, Brian. Very well done. You every once in a while you hit an aha moment, and the book gave me the aha moment when the delta theta ratio that we used to use, and the Vega theta, was one way of looking at your Greeks to check on your position. But Brian is right. It did lack something to it that didn't give you enough information. And when you start thinking about your risk reward, and he's plugged that into the formula, it really sets a new tone to not just the trade and looking at adjustment points, but for me, it's my attitude of when do I take it off? At what point am I risking hello?
I can hear you, Paul.
Oh,
yeah, I can hear you.
Oh, all right. I saw the post. Sorry. So now what happens, I start looking at the trade and see where I am in the trade, and, now in my mind is the risk reward. So that's been very enlightening for me. My trades are set up a little different where the Greeks are actually, I don't believe them. They don't work with this trade. So, I'm going to modify a little bit how Brian does the calculation for his numbers, but I'm going to start incorporating that into the trading system at some point. And it's mainly because the calendars above the money act differently than an at-the-money calendar. So I think what I'm going to do is put everything independently, have basically use Ryan's Johnson for each piece independently, so I manage them with the risk by themselves. Mm-hmm. The only way I can see doing it in my trade.
Well, and I can understand that, Paul, because, this isn't a comment about, Brian, your formulas, your work. It's just a comment about the Greeks in general. Don't forget, the Greeks are a snapshot in time. They are where things are currently in the market. If the implied volatility ends up changing in any way, shape, or form, like, for example, if the put skew, the implied volatilities of the puts below the money end up being much higher than the at-the-money puts. Recently in our institutional hedging business, that level of difference, how high the puts were at 4% below the money versus where they were at the money, we were at a 2-year, over a 2-year period, we were at a 3 standard deviation steepness to that. And one of the things that ends up happening is that all Greeks or implied volatilities, they don't change at the same rates. So, when I take a look at things, when I say that all Greeks aren't that aren't created equal. My good friend and colleague John Locke ends up talk about how the Greeks are trending. So when we think about delta, for example, if you take a look at let's say a 1 or 2% in the money puts that's going to expire on Friday versus let's say the same 2% put but 6 months out, the delta ratio is going to end up changing much more rapidly on that shorter term. Your deltas are going to be much harder, meaning that they're not going to end up changing as much because you're already 2% in the money with only a couple of days left to go. However, as you get closer to the money, that gamma risk ends up changing dramatically. And Brian's stuff, okay, to his credit, by the way, a lot of people don't end up including that gamma calculations, and he does, okay? And, you really should take a look at his book and the formulas. But what he can't do, not because it's not, but you can't end up taking a look at how the Greeks will end up changing. So you have to end up knowing on a strike by strike or a position by position, this option it looks like this in terms of how hard or soft the deltas are, and you can end up seeing that. What I'll end up doing is I'll go through this, and then I'll end up going over to LiveVol, and I'll give you an example of some of these things. One of the things that ends up happening, whether you're looking at your delta or you're looking at your Vega, a lot of times at how quickly, okay, your deltas are going to change. If you're doing calendar spreads or you're doing at different things in different term structures in different months or weeks, what will end up happening is that you can end up having things that are so far apart that you're mismatching your gamma risk in what you're thinking you're protecting in one option versus another. The last one, okay, and the two things, okay, that Brian is addressing, and the two most critical things is how quickly my deltas change, so you have to take a look at your delta and your gamma there, and how quickly my volatility changes. And when we take a look at volatility, there's two separate pieces that you have to end up thinking about. And in that, that's what we were going to end up focusing this conversation on. Okay, I wanted to end up talking. We could talk about, all the different pieces, but they're complex conversations enough. So I just wanted to end up talking about the difference between Vega and weighted Vega. And by weighted Vega, what I end up meaning is that I use the term, okay, Vegas melt with time, meaning that as you get closer to expiration, okay, the Vegas will end up being smaller. So if we look at the same strike with 1 month versus, say, 3 months, that 1 month, okay, option, the exact same strike, will end up having a much lower Vega, okay, with the shorter time frame. So as time passes, the Vega of that same relative strike at the money, or 2% above the money, 2% below the money, it will end up getting smaller and smaller. This is offset with the fact that the shorter term options, by the way, that's called term structure, right? The short-term options versus the long-term options. What ends up happening is that the short-term options end up moving the implied volatility of those move much, much faster than the longer dated ones. Okay, so understanding that, yes, if I'm looking, let's say, at a 2-month options, I might be carrying a lot more Vega than I would in the front month, or let's say with a 1-week option, but that implied volatility of the 2-month options is going to move a lot slower than it will in the front month. And when you take these Vegas and you just add them all together, okay, it really gives you, I think, a misrepresentation of the way your position is going to end up actually responding in the real world. The concept of how the front month implied volatility moves at a much quicker rate than a back month volatility, that concept is called weighted Vega. Okay, and it needs to be taken into consideration. Many times I've seen people say, oh, I have risk, So what I'm going to end up doing is I'm going to end up putting on a calendar spread. And then what ends up happening is that it ends up moving towards your calendar spread and you don't make as much money as you thought you would, or it moves away from your calendar spread and you lose more money than you thought you would. And that's because the front month and the implied volatility of your short contract is moving at a faster rate, because in a calendar spread, that's your short contract's always in front of your back month or your long contracts. And that back month long, contract is moving at a slower rate. So what happens is that you're not getting the hedge that you might have thought that you were. The way the industry term, right, the institutional guys will always take a look at this, and they call this concept, they always look at what their shared variance of their Vega is. So for example, if I'm looking at a contract that has a 1 month difference in it, and I take a look at a 3-month contract versus a 4-month contract, today's expiration, what you'll end up seeing is that first 3 months is shared, with the first 3 of the 4 months in the long contract. So my shared variance is, I have a 75% shared variance. So the Vega of this is a lot truer. It's going to end up moving. If one moves, the other one's going to be pretty close to it, 75% shared variance. However, as they expire and they go down to 2 months and 3 months, 1 month and 2 months, when they get down to 1 week and 5 weeks, now they only share that first week, and that second one has either 5 or possibly 6 weeks left in it. Here I'm going to have at most a 20% shared variance. So what ends up happening is that the longer I have between my strikes, the more my IV risk and my gamma are going to be misaligned. I think that probably one of the biggest misnomers I've ever seen in this is sometimes people end up thinking about buying a much longer term put to be able to end up hedging the market moving down, and it will end up working. But what ends up happening is if you start to sell puts against that, you start selling 1 month, puts. Think about that. What ends up happening is that the front month, versus a leap, you have a 1 month versus a 12. You have less than a 10% shared variance. So you really have misaligned. And you've totally overstated, how much gamma protection you have, because that 1 month put option may have a very small amount of Vega compared to the 1 year, but if we end up having a drop, that front month volatility is going to skyrocket compared to the back month. I don't know if I have this here. Let me see if I can end up coming over here and just opening up a new window. But let me get rid of this. I think that, I could show you on different Central. I think does a pretty decent job, and I know we did this before. What ends up, did I not get that? Let's try that again here. This is a normal environment. What VIX Central is showing you, it's showing you what the futures are trading for at the VIX. Now, this is not a perfect science, and I'm only looking at the, the average, implied volatility, and this has nothing to end up doing with the skew, meaning how expensive the puts are below the money versus the call in any 1 month. So this is only, if you will, one dimension of the problem. But when I take a look at this, this is pretty much a normal contango curve where the front month is trading at a lower price than the second month, it's trading lower than the third month, and so on. And you can end up seeing, as you come down towards the front of this, what ends up happening is that it becomes more and more steep, meaning that the front month has a bigger difference. You can see it right here. It's a 5.2% difference compared to the first and second month. The second and third month only have a 2.4. So this is a very normal environment where the back months, have higher implied volatility. So what ends up, and they'll carry more Vega, and I'll show you that in a minute on another screen. So what ends up happening is that when the markets start to drop, and if there's any type of a market duress, what will end up happening is you'll see the front month move at a much quicker rate. Big Central was very nice to end up showing you one of the worst days in history. And I want you to take a look at the difference. Here's today, right? So today the back month's at 20.3, the front month's at 17.6. If I go back over here and we end up taking this to October 16th, 2008, that back month, the 240 days, only went from 21 to 27. The front month went from 17 up to 64. So you can see that that front month can end up being much more volatile. And if I was to end up weighting my Vegas in the back month equal with my Vegas in the front month, you can see how those front month Vegas have the possibility of moving much, much more. So that's why we end up saying all Vegas are not created equally. Okay. If I end up going back, just to kind of end up wrapping this up, because Paul has done a lot of work, okay, on this. And let me just come over here. What ends up happening is that when that front month really ends up spiking, and Paul, maybe you could pass the ball to Paul at this point, Tom. Paul, what I'd like you to end up showing on your Thinkorswim or your option view or your live vol, whatever you happen to have open, could you just open up the options chain, just a few strikes close to the money? And I'd like to end up taking, and I don't care, I know a lot of our readers and listeners end up using either the RUT or the SPX. What I'd like to end up doing is taking a look at those implied volatilities at the money, okay, versus the longer one. So for example, let's just use the 1 month. Okay, let's open up the March monthlies, and then let's open up something, maybe in January or, whatever you have, the first one later on. Yeah, just a few of them. That's all we need. Let's go way down. Yeah, let's take a look at January 16. That's good. So that's about 10 months difference. Okay, when I take a look at, let's take a look at the, I don't know, the 20 is, where are we? The 2100 is a reasonable one to look at. Okay, and we'll stay on the right side. Okay, and you take a look at what those Vegas are. Vegas, 7.93. What's the 2100 trading at in March? If you go up to the...
Let me get rid of these distractions here.
Okay, actually that would be great. There you go. There, we can put everything on there. Okay, and now also select... Okay, look at that. And, go ahead, Paul. What I was going to say here is if you take a look at the Vega, right, instead of being 7.93, it's only 2.36. Paul, also, do me a favor, open up maybe June. Okay. Now take a look at it. You see how as there's less and less time, okay, as there's less and less time. Also, you can open up, if you can fit it in there, open up May and April, okay?
Try this, see what happens. There we go.
There you go. That would work perfectly. Yep. So you can see that Vegas end up getting smaller and smaller as you get closer to expiration. That's why we use, or I use the term, Vegas melt with time. That they will go, at expiration, they'll go to zero. Friday, we only have, okay, Friday, if you open up, oh, there we go. You know what? Open up, open up February. Look at what happens here. Here. Okay, these are expiring. Okay, tomorrow, right? Right. They're on the opening print tomorrow. Okay, that's why they're not zero. Okay, if it had already expired, they would be zero. But you can see how these things get smaller. So knowing that the front month implied volatility can move at a much, much quicker rate than the back months, and the Vegas are smaller, you have to kind of make some type of adjustment. That's why sometimes when people end up saying, well, I'm going to end up using this level of, buy enough Vega, and I'm going to do it with a calendar spread, and I have options in different months. As soon as you have options in different expiration cycles, okay, your Vegas are no longer just a true flat Vega within 1 month. Okay, they end up decaying. And people end up. I see that there are a bunch of comes in without question. I know that they end up like with as you end up getting with less time, they are decaying, okay, at the rate of time squared or R squared. So that becomes a very important thing. Paul, you have taken a lot of these calculations, read a bunch of stuff from different authors, including Taleb. Can you end up showing us, how you end up taking a look or try to estimate what the actual real effect would end up being in some type of a market move and volatility changes?
Sure. I put together a spreadsheet that I have actually been doing some testing on, to make sure that the calculations are right. But what I find is it's very interesting that this comes from Taleb in his book talking about weighted Vega, and is basically Ray is correct. It's the square root of time. And so what you're comparing is the days to expiration to, so this is a 60-day trade. So the base day I put in was a 60-day trade. This is the DTE for the front and back month, and it gives a calculation. What happens, why I've been interested in doing this is, if you go into TOS and look at, let's go up a little bit and get rid of the iron condors. So now we just have the calendars on. So, we're all aware that, if you change your volatility here, it changes the front and back month the same. So if we go up 1 point, it's showing that, even if we go down, you'll be fine. The P&L will be fine. But with the weighted Vega, this front month will go up 1 point, but the back month is not going to go up 1. You could see that from the graph from VIX Central, that the front month is much more volatile than the back month because of event risk. Nobody's buying insurance, 2 or 3 months out. They're buying it immediately, that current month. So, that has all the pressure on it, which happens to be your short. So what, the weighted Vega, what I was curious about is, is there some way to quantify what I should be changing these numbers to, rather than a guess. Well, I think this will go up 1, this might go up 0.6, but who knows? And time makes a difference as to how much each one goes up. So with the formula, with the discussion Taleb had, which is fairly vague in his book, I did some scrounging around on the web and basically came up with the square root of time to try and figure this out. And these numbers represent what you would change the volatility to on a 1-point vol change. So you can see the front month, back month, what's happening, what you would plug in here. And I put in the difference. So if you're out, 56 days to expiration in a calendar, the difference between the two is 0.19. As you get 28 days, it goes to 0.3. If you're 8 days to expiration, look at the difference between your front month vol and volatility and the back month volatility number that you would plug in. So your front month will go up 1.9, actually 1.9 for a 1-point move in vol, but the back month will only go up 0.7. So,
right. Now, Paul, what Paul's showing you right here is what, the institutional traders call that shared variance. Paul, if you go back to the spreadsheet, if you take a look, and I mean, he doesn't have it calculated there, but it's very easy on the spreadsheet to be able to end up seeing that as you get closer to expiration, like for example, if you end up having the front month, okay, where you had 8 days, where the back month you end up having 36 days, what do you have, about a 6%, okay, overlap of, I'm sorry, it's more than that, maybe about a 20% overlap, versus
Yep.
in the back months, okay, you're up at what, maybe about 75% or so. It's a much, much bigger difference when the time frames end up being longer. Now, even if you use things that are relatively close, 1 month apart, what happens is that that shared variance will shrink every day as you get closer to expiration. And so what ends up happening is that your Greeks, when you're looking at them, are a snapshot in time. It doesn't show you how the weighted Vega is going to be affecting your trade more tomorrow and the day before, or the day after, and the day after, and the day after. So, one of the things, and I know that some people are writing the names of the second level derivatives, but, I've always put it this way. We know that delta is basically, if you want to take a look at delta, is how much you'll end up making or losing if the stock moves $1. And we know that that amount will end up from $0 to $1. When you go from the change of $1 to $2, the delta will change by gamma. But how much will it change if you go to $2 to $3? That number is going to change. Now, if I'm trading a $10 stock, it's, I'm pretty comfortable with this. But what happens if I'm trading a $2,100 index? Do I really care about a $1 or a $2 move? No, I care about $20 moves. So at that point, I need the delta, the gamma of the gamma, the gamma of the gamma of the gamma, and so on until I get to $20 worth of moves. And so when we take a look at how much things end up moving, I know that Brian's done a very good job of taking a look at how to end up doing the calculations of those larger moves. But what happens if one is going to end up changing in 1 month and another is going to end up changing in another month? Well, you can still do the calculations separately, but now you also have to worry about, one, how much the volatility is going to move in 1 month versus another. And then 2, Paul, I don't know if you have live vol. If not, you can do it in Thinkorswim. They just don't do a very good job of it. Can you end up showing the skew? Okay, so what ends up happening is that if you have a large move, and get rid of everything except for maybe the ones that we were looking at, the monthly, March, and take a look at the March, the April, and then we're also looking at the January 2016. Okay, so what ends up happening here is that if your price moves, one of the things that will happen is that you'll move up or down that skew curve. Okay, if we move down 50 points, your relative position on the skew line will end up changing. That's the first change that you have to end up worrying about. The second change that you have to end up worrying about is that what happens normally, not always, but if you end up having a large drop in the market, what will normally end up happening is that all of the implied volatilities will get higher. Yeah, get us more strikes too. Give me at least, that's good. Maybe even do 100, okay, if it's okay. What will end up happening is those skew change, the skew, okay, and that's the difference between the at the money, okay, call or put, and the out of the money. What ends up happening is that those puts tend to go up much, much faster than the calls do. One of the reasons why you see the shorter term, right, and that's the white line, the Marches, end up going up. I mean, I don't know if you can end up holding the cursor over this, but what happens is that when they become such a small amount of money, the difference between, let's say, 15 cents and 20 cents, if that's the mid price, will make a huge difference in the implied volatility. So what ends up happening is that don't be fooled by the right side of that white line going up, of the shorter terms have a much higher implied volatility, okay, at 2200 or at 2250. Well, at 2250, they're not even trading. Okay, at 2225, I don't know what they're going for. 50 cents, 25 cents, right? They're going to be so cheap, so that it really ends up you almost have to take a look and say, well, the probability of getting there is almost nothing, so I don't really believe that implied volatility. But at the money and below the money, those are worth a lot, and you'll end up seeing the time factor change. Now, also, these things end up changing, okay, at the money versus out of the money. I don't want to end up getting into how theta actually decays, but, I know that like one of the big misnomers is that everybody's always taught that time decays most at the money. But if you take a look at how much is decaying as a percentage of itself, Paul, can we go back and take a look at the chart on the top? Okay, let's get rid of this, and just for example, when you take a look at, and you know what, let's just look just at April, and instead of 8 strikes, give me 50 strikes. Okay, when you take a look at the theta, of course the theta in an absolute number will be the most at the money, but look at it as a percentage of itself. So I'm taking a look at a theta that's 37 cents, okay, the close to the money, okay, and that's a $40 option versus, let's say at the bottom of the screen, okay, if I take a look at the 2140, all right, and the 2140, that's 30 cents, so 7 cents less. But if you take a look at the price of the option's less than half of it. I didn't lose half my theta. Okay, so what ends up happening is that theta decays off of the price. Because when you look at your theta, I always look at it, yes, you have to look at it in an absolute number, but you also look at it as a number versus, what am I losing of? So theta also is not, doesn't decay, evenly across every strike. So, when we take a look at these things, that's why we say, all Greeks were not created equal. So when Paul uses Brian's work in and around, how he's calculating the risk, and the risk meaning the risk of what's his risk of, right? Because there's only 3 dimensions here, right? There's price movement, there's time, okay, movement, meaning decay as you get close to 0, and then there's volatility, applied volatility. And so very much so, I like the way Brian ended up doing this, right? He's thinking about what's my price movement divided by how much I'm collecting on my time or my theta. What's my volatility risk compared to my time? So those are the 2 right ways to end up doing it. And, what we want to just kind of point out here is that these are fluid numbers, and if you're looking at multiple time frames and you don't take that into consideration, you should do all of the work, okay, in terms of understanding your delta risk and your volatility risk, but you should also end up taking a look at it from a Vega perspective and a weighted Vega perspective. We can also, and we don't have time to do this today, we don't want to end up going in today, but we will end up going into, Paul and I, we'll talk about how much, what your gamma risk is actually, and how your gamma risk as you get closer to expiration, the concept between hard deltas and soft deltas. And you do need to end up considering, okay, that as in a dynamic environment, because as your deltas get softer, okay, you may have to take much different adjustments than if your deltas remain, very hard. Remember, if you own the stock, your delta is 1 and you don't have any gamma or, okay, any other risk. So those are important things to be able to end up taking a look at. I know that a lot of you have done, okay, this and taken a look at it. And I'm looking at all of these quotes. Tom, some of the questions here. First one I end up seeing here is I'll just say, Brian, thank you very much. He agrees with us, and the weighted Vega, okay, what he ends up calling the true Vega. Yeah, I've heard it also called true Vega. Should always be put in a risk management scenario. And it does give you your true, risk-return ratios. And these are things that professional traders, okay, end up, they care about these things immensely. And I think what ends up happening to the casual retail trader it's just a step beyond, and all of a sudden, okay, when they get whacked on a trade, they don't end up realizing it, so they do need to end up taking that into a consideration. Bob ended up saying, does Brian's Excel spreadsheet show all of the actual eye use in trade, and not just the conceptual presentation? Brian's spreadsheet shows you all of the real risks in the trade. What it's a little bit harder to end up doing, and I don't know if you can do this just in a spreadsheet without actually building an options, a surface map, meaning the term structure and how the implied volatility is going out. Because if you think about this for a second, okay, think about Paul. If we went back to can we go back to the skew curve, okay, on the bottom, and just pick 3 or 4 months. Okay, and that's good enough right there. Now think about this. Every single strike has its own implied volatility for March. Okay, and you can see that in the white line. Every single strike for April has its own implied volatility, and you can see that in the curve in red. Every single strike in June, the same thing. Now, if we were to plot all of this, we could actually make this three-dimensional surface map. Okay, and it would kind of look like a terrain, right? It would be a surface map. And when you're trading, to understand how that ends up looking is extremely important. And you can't just be blind to this. Remember what I told you, I work with an institutional company that does institutional hedging for other hedge funds and mutual funds and pension plans and family offices. And they always take this into consideration. The hedge that they just put on 1 month out, using 1 month or 1.5 month options when they put it on, they ended up using just pure put verticals. Now, they normally wouldn't do that because it's not the best way to end up hedging the downside, but they ended up using that because the steepness of, in this case, at the time it was the March line, now it's close to what the red line would be. At least back when we ended up putting this on a couple of weeks ago, we were at a 3 standard deviation move to how steep that put skew was. So that gave us some of the best risk reward to be able to protect the downside. So what we're saying is that when you take it, now that was all in the same month, right? So that had no weight in Vega. But normally what we'll end up doing is that we love to end up, okay, when we're hedging downside, we love to sell the front month options, because what ends up happening, if we're going to end up selling, let's say the 2050 or the 2025s, okay, we'll sell those in the front month because the implied volatility is relatively high and the theta drops off quicker. But then what we'll do is that we'll buy options, okay, further out in time and further below the money. Because doing this diagonal, okay, we know that if we end up coming down, okay, if we end up only going to our short strike, that one's going to expire worthless and the back ones are going to be worth a lot more. But what happens if we blow through it in a crash scenario? Well, we need to end up taking care of that. So what we end up doing, depending on our hedge, we'll end up buying more options in the back month. It's the ratio, the difference between the strikes, the number of options they sell versus what they buy. That's what they consider their proprietary secret sauce, and they do a great job at it. And they've modeled all of these things out. And so what they're always looking for is the same thing you should be looking for. And what they're looking for on the downside, they're looking for the most efficient, effective hedge that is relevant. And by relevant, I mean if you end up buying options that have a very, if you buy puts that have a very big difference between the options that you sold and the options you bought, you could end up buying puts to protect the downside that look really good now. But what happens if the S&P moves 10 or 20 or 30% over the next 9 months and you bought a 12-month option? Well, if you bought a put at the money and we move 30% above it, I think that's pretty much the definition of an irrelevant put, right? Because you're going to be 30% below the money before it gets to be used. So how do you end up taking a look at your current Greeks? And that's why we say that it's a snapshot in time. There are just so many comments. I'll end up asking Tom and Paul, let's take a crack at some of them. I have not been watching them as they've been rolling by. If we go front to back, downside protection as far as a short strike, I'm going to put vertical. Yeah, Paul, that's what we were talking about, is kind of doing a diagonal on them. You know, synthetic covered call, this is a good point that Dave brings up. One of the things that we did in our covered call class, where we did end up, you know, buying a leap and selling against it, is we were trying to do a stock replacement. So buying a leap, a call leap, and then selling, you know, front month calls against it. I'm not playing this as a volatility trade. I'm actually playing this as a stock replacement. It actually works pretty well, because what happens is that if we do end up having a crash scenario, think 2008, and my in the money, okay, call that I bought as a leap, as we come down, it's going to lose a lot of money. But one of the things helping to offset that loss, that delta loss, as we come down to the strike and maybe in both, is that the implied volatility may end up going higher with less as time ends up going and melting away. So what ends up happening is that you're actually risking a lot less money, even less than you might think, by buying it. Yes, you are paying a little bit of the theta, because you know, even leaps, you know, you're losing money on your theta, but it is a replacement strategy. So it can end up, okay, working in some environments on the using leaps to stock replacements and covered call strategies. But if you're using it in protection scenarios, you do have that Vega risk that we talked about. Ray talked about, you know, the 75 to 100 delta ratios don't drop as easily as soft deltas. Without question, Ray. You know, one of the things that by hard deltas, and thanks for putting that up there. When I end up having a 75 delta, okay, or an 80 delta, and I hate to do this to you, Paul, but can we go back to the, let's take a look at the different ones, and I want to take a look at, this time I'm going to need at least 20 or 30 strikes, and I want to look at the January 2016s versus the Marches. Okay, and this is what we end up meaning. This is the actual example of it. I want to take a look at the deltas at the money, and let's say let's do a little bit more. Let's go down to, let's take a look at the 2100 and the 2000s. So what do we need, about 45 or 50 strikes? Perfect. How'd you do that? Oh, it's 25. You do the math. Okay. Okay. I didn't realize that. Very good. Let's take a look at the deltas, okay, here. So if I take a look at the 2100 deltas, I'm at 49. Now, you missed it by one, Paul. That's the 20.
All right. You want to do the puts instead?
No, we can do the call. The calls are fine. Okay, so we're at 49, right, 49 and change, our deltas. Now, if we end up going and taking a look at the, I want to look at the 2050, okay, and let's write these things down so that, because they're going to be on different screens. So I'm looking at the 2100, the 2050, and the 2000. So I'm looking at the 2100 is 49 delta. The 2150, is that 72 and change? Should I round that up to 73? And then the 2000 is at 86.5, so I'll round that up to 87. Let's look at those same strikes, okay, out in January of 2016. Okay. The 20 is not that big of a difference, right? This one's 20. It's 49 versus we'll round that up to 53. How are we doing on the 20? Did I go backwards? Okay. No, I didn't. I said 20. I gave you the wrong numbers. I meant to end up. Oh, no, I did it right. The 2050. How much is the 2050? The 2050 here is only, I'll round that up to 60. So it's not 73 like we were in March, okay? So it moved up less than half. How about the 2000 option? Here, instead of it being 87, it's only 66. So you see what happens is that as you get closer in, okay, your deltas, as you go further away from the money, will become larger. Okay, when you're in the money, smaller. The exact same thing would happen in the opposite phase if we looked at the calls, okay, going above the money. So when we take a look, Ray, at those harder deltas, when we are, let's say if we ended up buying that that 2000, okay, call, as time goes by, that 2000 delta will become harder, right? It's going to end up growing in time, okay? So when you look at these things, understanding how your deltas are either getting harder or softer depending where you ended up putting it. The same thing would end up happening, okay, if we looked at the calls above the money. They would be melting away. So those deltas at some point would almost become irrelevant because they're going to be so small, and for them to end up moving, there would have to be a massive move in the market. Okay, so you have to end up taking a look. I remember Steve Rashis. I don't know if you guys remember Steve. Steve was one of the first 15 employees of Thinkorswim. But I remember, I, and Tom Sosnoff, we used to have this conversation. One of the things that they used to end up doing is that at some point they would throw away, okay, their deltas. If something got down to, let's say a 5 delta or so, or 2 delta, okay, depending on time, they would just cross them off their sheets, not to end up having them, okay, distort their numbers, okay, because they were so soft at that point. The only way they would ever count is if there was this, huge move, and all of the other deltas would move so much that that one was almost irrelevant. Okay, so understanding how these things move is really, really important. And, I think that of all of these things, in the end, the bottom line is how much does it affect your P&L? Okay, because that's how everything always gets measured. How does it end up affecting your P&L? And so when you're doing modeling, okay, and you're doing your testing, okay, Paul, can we go back to your spreadsheet? Understanding, you can end up using, with different models, okay, whether you're using Thinkorswim or use LiveVol, and I know a lot of people have an issue with Thinkorswim Greeks, okay, especially in the money, and I don't want to open up that debate right now, but I think most people who use OptionView or LiveVol are very comfortable with their Greeks, both in the money and out of the money. They do a much better job of handling the cash settle dividend payment stuff. When we take a look at that, I think that you have to use, okay, some type of metric to understand your weighted Vega. Paul, if we go into your trade, could you actually show us, we have, maybe another 10 minutes or so, could you actually show us how you do this in a trade that you end up having open? And I know that you do use some of Brian's thought process about managing, okay, through this.
Right. Well, I've just started trying to develop a system with using Brian's spreadsheet because of the type of trade I'm doing, and I just, there just doesn't seem to be enough time in the day. So, how I will take a look at this calendar using the spreadsheet, as I showed before. So this is this cycle right here. So if I have the vol change set to 1, and so these are the numbers that I'll use to plug into the top. So it's 1.04. My memory's short. I have to go back and look. 0.85. Now that is, when I look, that's what I'll look at when I'm modeling this calendar to see, because I trade these based pretty much, I'm looking to fiddle with this calendar on a P&L level rather than a Greek level. So what this does is it helps me kind of project what my P&L is to say, okay, this is where I'm going to take this off. So let's take a look at here, this point here. So we'd be down, make it a little easier. Sorry, this thing is running slow. I haven't rebooted it today. So once I've done this calculation, it says I'll be down 137. Let's reset the parameters. 169. And if you were just waiting, you just go in here and you don't understand the weighted Vega. So you plug in, I want to see, my fire drill, let's go up 1 point in volatility. That's how much it's saying you're down. So what happens is I don't, the spreadsheet I use off and on just to check. But now that I understand how this works right now, I'm not going to do this every day on a fire drill. I might do this, every 3 or 4 days, because it'll change a little bit here. What really happens is when you get in, this is a little bit worse. When you get in close, that's when if you trade calendars with the short in the front month, this becomes much more critical to understand how it works and how to manage your trade based on this. If I was doing front month calendars, I would look at this every day, and I'd have my calendar leaned into the pain much more than I do now because of this.
Because your shared variance becomes so low at that point.
Right. Then you want it to become a little less of a weighted Vega trade at this point, and I want it to become more of a a delta trade. So I would want to keep this calendar up here. So it's going to run down. You've said this before that you like the trades that you run through your profit zone when it's getting in trouble. So front month calendars, I would want to put, if I'm doing put calendars, I'd want to lean them so that they're sitting somewhere in here. Now, I don't trade them, but I from my back testing and looking at things, this would help you survive. It's it's funny if you put here's an opinion. It's not been tested yet, but as you go down in this calendar, the front month volatility is going to go up enough that it's going to flatten this curve out, and it's going to act just like this trade. It's going to, the T0 line is going to act very similar to what's going to happen in this negative Vega trade. It's going to flatten the T0 line out, and if you're ahead of the curve, you'll be able to sit in it. You won't be down a lot of money as it comes down. It's I don't know if this is accurate, but I was playing with this. These are the Vegas of the 28-day trade and the 56-day trade. My strikes are at 21.20, so I took the Vega numbers from TOS and I plugged them in here. So what you'll look at your 28 DTE. If TOS, it's pretty close. TOS will say that you have plus 101 Vegas. Weighted, you only really have 6.24 of positive Vega. But that kind of coincides with I'm in a calendar and it's going down and I'm losing money. The volatility is coming up. Because the reality is, if you weighted the Vega, you really don't have a lot of Vega in the trade. Then if you're out in where I trade calendars and you weight the Vega, look at that. I made a comment to a couple other people that, you know, these long-term calendars are actually negative Vega trades.
Yeah.
They don't believe it.
There's been a bunch of comments that we've been going through this kind of quickly. And by the way, if you remember, we talked about how all Greeks weren't created equally, and I said we're only going to focus on Vega, okay, because we really want to be able to end up going through this. And even this is a little bit difficult. We've been going almost an hour now. Paul, would you come back and actually take us through this? Because one of the things that happened to me, and this, I did this maybe 15 years ago. Okay, I sat down and every single day before we had all of these great tools, I wrote down the Greeks of each of my positions, my total, and then I would end up actually doing the math. What happens if we went up, 0.5% or 1% or down? And I do all the math on everything in Excel. And then at the end of the day, the Greeks would all settle out. I'd have my P&L, and it never worked. I was never close. Why? Because the implied volatility changed and the skew changed. Would you go through this maybe in option view? Okay, show us the spreadsheet, how it ended up working, and you can take everybody through how you end up managing trades. Because when it comes to managing by the Greeks, and it comes to end up doing this, of all of the traders that I know, I think that Paul does the absolute best job of the best guess of where the real P&L is going to end up being when it moves, because he takes into effect, okay, this weighted Vega concept, and he ends up using trades that truly will end up hedging out his Vega and just not, well, this calendar says I have this much, so therefore I believe it. I'd like it if you could maybe, and we'll put Paul on the schedule so he can back and he can go through everything in more detail. And Brian, you didn't sign on or you didn't call in, but our community would love if you would come back, okay, and maybe go through, okay, your spreadsheet. We have a lot of folks that have read your book and use your spreadsheet, and we always talk about, the risk-reward ratios. We're always looking at deltas, and we're always looking at, our Vegas as compared to our deltas. And you've given, I think, some great work to a lot of our folks, and we really, really appreciate it. And Paul, I know that our community really appreciates everything you've done. I mean, you've just added so much to it. So thank you very, very much.
Oh, no problem. I was just looking through Bob Alexander. Did you see the comment from Bob?
I didn't. What I'd like to end up doing in the last few minutes, if we could just end up answering a few of them, any of the comments you thought, because there were a lot of them.
Yeah, there were. They were. It kind of looked like they were talking amongst themselves. But Bob brought up a point that the risk is low, but so is the reward, to the point that this has way too much complexity and adjustments for the effort. At least that's what it appears to me. Perhaps I'm missing something. Actually, Bob, here's a little quick on the trades that I'm doing. I go way out in time. Here's the start of. I'll put the whole trade up, and just quickly. You look at this trade, and you look at the numbers, and they're very low. And you're right, it appears to be complex. The way I trade it is fairly simple. It's put things on, take things off. There's really no real, there's not a lot of adjusting to it. What I found is, my discussion that Greeks lie is, after doing this, I don't know, I think I've got 7 or 8 months of doing this, starting this trade live after testing, is that the theta lies. And I'm not sure exactly how to quantify it yet. But when you're out 60, 70, 80, 90 days, and you have very, very low theta, all I know is I can take this trade off and make the same amount of money as a 30-day trade and do it in 30 days. Go from, say, 60 days to 30 days, and I'm making pretty much the same money that I would make if I did it 30, 35 days out to expiration. I think that the Black-Scholes formula when you get out that far in time, does not calculate the theta as well as it should. I think there's much more time decay when you're out that far than what these numbers say. And, and that's part of doing a trade over and over and over again to really see how it's functioning. Because there's only one Greek that I follow, and that's gamma. And I'll take this off with 30 days to expiration, period, whatever the P&L is.
Right.
So I hope that answers the question a little bit.
I think it does. We're going to spend a whole session on this. I don't know if you guys saw it, but Brian has very graciously ended up agreeing to come on and talk to all of us. He's in the process of writing a new book. Once it gets published, he's going to come on. Thank you so much, Brian. We'd really appreciate that. And Paul, we really end up appreciating this. And what we're going to end up doing, I know Paul will end up getting into this. What ends up happening is that the Greek that he talked about, the one that he worries about, that's because gamma ends up exploding higher as you get close to expiration when you're near the money. And that's the one that's going to change your T+0 line the most. And so we really, really look forward to Paul coming on and doing a full presentation. We'll give everybody enough notice when he ends up coming on. And he'll end up showing how he puts his trades on, how he manages the Greeks. Paul, I love when you come on. Okay, Paul and I used to end up trading together. And I miss our sessions. Thank you so much for coming and sharing with us.
Oh, no problem. My pleasure.
Thanks, Paul.
Okay.
Thanks, Brian. So I think, Jim, that's it for today, isn't it?
It is. Thank you very much. And we'll end up seeing anything coming up on the schedule you want to end up mentioning?
We've got Dan Passarelli next week, market taker, and also Bill Gary. So we're actually going to have 2 roundtables next week. So should be a busy week.
Okay, and maybe we can and we'll schedule, okay, so that means not next week, maybe the week after we can have Paul on again and he can end up going through his trade.
Absolutely. We'd love it. All right, thanks everyone for sticking with us. We really appreciate it, and we will see you next time.
Bye now.
Have a good night, everyone.